You got a lot of cash. You made a lot of money. What are you going to do with it?
Well, Alex, it's good to be with you too. We had a good quarter, and look, we're winning back investors with higher returns. Year to date, our return on capital employed is greater than 20%, and a strong cash yield of over 7.5% if you take the dividend and the buyback. Together, we're investing in lower carbon. We're a leader in methane management. We're the second largest biofuels producer. We're investing in growing that here in the United States, and yet we still trade around only half of the market multiple. Energy represents about 5% of the S&P 500 by market cap, but more than double that by earnings. So we're staying disciplined and intend to continue to execute.
So back to the money for a second, though. At some point, though, if you keep making this kind of cash, you're looking at either raising your CapEx, and already you're looking at the high end of your CapEx guidance, or increasing shareholder payouts. Can you rank that?
Well, we've got a very consistent capital allocation framework that we've maintained for a long time, for many, many years. And it starts with the dividend and returning cash to shareholders. We've got a 3.5% dividend yield. We've increased our dividend for 35 years in a row. Our second priority is to invest to grow both our traditional and our new energy businesses. We're up 50% year to date this year versus the same period last year, and have guided to staying within our range, but increasing again next year. The third priority is to maintain a strong balance sheet. Our net debt is below 5%. We've reduced debt 6 quarters in a row. And then the fourth priority is to repurchase shares. We've bought shares back 15 out of the last 19 years. We're currently at the high end of our guidance of $15 billion per year, which is about 4% of the outstanding shares every year. So it's a balanced approach to capital allocation. And as we go through the cycles, we intend to maintain that balance.
Okay, so even with all the money, still going to be balanced. Mike, let's go to the Permian for a moment. I mentioned that it's really on fire. Darren Woods on the call from Exxon just talked about the fact that the Permian should grow 20% for them this year versus 25% last year. And I wanted to get your take on what you think Permian growth is going to look like.
Well, we had another quarter of record production. Our year-to-date Permian production is over 700,000 barrels per day. It's up 15% versus the same period last year, which was about 600,000 barrels per day. We've been increasing activity. We're spending $3 billion there this year. We've guided to $4 billion next year as we bring more rigs into activity. And so, yes, I think the Permian is a great resource for this country, and it's contributing to the growing energy supply that's so important in this economy.
100%. And I wonder how long that can continue as you have inflation continuing to rise, particularly in the Permian, and labor shortages. Can you walk me through kind of the trade-off of how costs are rising in the Permian versus what you think growth is going to be able to be like in the Permian?
Sure. We do see tight markets for rigs, for completions, for pipe, sand, all the things that go into production there. We plan our work and work our plan. And so what we're doing this year, we had planned last year and the year before. We have contracts lined up for rigs and for crews to meet the profile I talked about as we move into next year. So we've kind of planned through the cycle here. But I do think there are some real constraints that the industry faces in accelerating beyond the rate of activity that we see underway today.
Mike, good morning. It's Guy. These are great numbers. These are fantastic profits that you are generating for your shareholders. Would you call these windfall profits?
No, I wouldn't. We're in a commodity business that goes through cycles. There are hard times, as we saw just 2 years ago, where we had enormous losses. You move into another part of the cycle, and we have strong earnings. Good times don't last, just like the difficult times don't last. We have to invest through those cycles, and it's important that we do in order to continue to meet the growing demand for energy. We need an approach to energy that balances economic prosperity, energy security, and environmental protection. And that's, I think that's the frame that we think within, and that's the frame we try to engage with policymakers within.
And what are those policymakers saying to you? Because the noise around windfall taxes is growing, Mike. I'm sure you're more than aware of that. Do you think you're going to end up paying them?
Well, we've seen that tried in the United States in the 1980s, and the result was lower investment and lower production. Typically, if you want less of something, you tax it. If you want more of something, you tend not to tax it. And so, a short-sighted approach to a commodity business that sends a signal that's the opposite. We actually want more supply, and so a tax on the industry that would invest in bringing more supply is not something that we believe would be productive.
The president, as you say, is taking a tough line with the industry. Seems to be attacking the industry on an almost daily basis at the moment. Do you think the tone coming from DC changes after the midterms?
Well, we've had some constructive discussions with the administration. There are areas of common ground. We share their objective of ensuring safe, affordable, and stable fuel supplies. I'd like to see more collaboration between our industry and the administration and work towards common ground. We need more energy of all types. And of course, we're investing in renewable fuels. We're investing in hydrogen. We're investing in carbon capture. The administration has made, greenhouse gas reduction a priority. So have we. Mm-hmm. The administration would like to see more traditional energy investment. So would we. We've received some mixed signals, and I think we could benefit from further dialogue to see if we can't get the words and the actions and the policy to align that create an environment that would encourage further investment.
Talk about further investment and then the government. I feel like the rubber meets the road when it comes to Venezuela. There have been talks that have been evolving between the two governments. What is your conversation with the government when it comes to Venezuela? And are you kind of readying things to kick off if sanctions are removed?
Well, we operate within the license that the government has given us to comply with those sanctions and have very limited ability today to try to ensure the safety of our people and the integrity of assets. There are discussions that have been reported in the media within the administration that we aren't necessarily a part of. And so, we're trying to maintain the capacity to help invest in producing more supply for the world markets, if and when the sanctions would be modified. We don't lobby for or against sanctions. That's the purview of the government,
Sure.
not our company. But we're always preparing contingencies for an evolving set of circumstances.
How quickly do you think you could ramp up if there was a thaw?
Well, we rely on service providers and others. So mobilizing people, mobilizing equipment and materials takes some time. So I think you're talking about months and years in order to begin to maintain and refurbish fields and equipment and change any investment activity. But it's very hypothetical at this point. I don't know how the policy would unfold, but it wouldn't be an instantaneous effect.
Mike, let's bop around the world, but you're a well-traveled man, so I'm sure you'll be able to keep up. Europe. I'm here in London. Europe's got a bit of a gas problem right now. The solution, certainly in Brussels and elsewhere, is to talk about a gas price cap. What do you think of that plan?
Well, the real solutions are in supply and demand. And that's where price gets set. And there are a number of policies being discussed in the short term about price floors, price caps. Where I think the focus would be best placed is how do we encourage investment in diverse, reliable, and affordable energy supply. So in the short term, a price cap actually would mute the signal which says produce more, consume less, and I'm not sure that it solves the problem in the long term. And so I think the discussions are best focused on what does it take to invest in infrastructure, invest in supply,
Yep.
have diverse supply, and meet the environmental goals that we all share.
I'm sure you talk to European customers all the time. Where do you think the argument is right now vis-a-vis longer-term contracts? And what do you think longer-term contracts actually look like? And why is Europe so reticent?
Well, it's a very interesting point, Guy. The investment in liquefied natural gas, which would be an alternative to gas coming in on a pipeline from Russia, the investments are massive. They're billions and billions of dollars. They take years to actually execute, and then they take decades to pay out. And so investors are, reluctant to make those kinds of massive capital investments without some certainty that there's a customer on the other side of that that will be there to actually purchase that supply. And I think in the present context, there's a very short-term focus in Europe, rightfully so, given the immediate circumstance. And where we really need to have a discussion is about the longer-term energy mix that economy will require, so that investors can put the capital to work in order to be a part of that. And so this issue of committing to longer duration contracts, I think, isn't going away. I think we have to sit down and have an honest conversation about what that mix looks like, and then I think you'll see the investments be sanctioned and move forward.
Yeah. Like they want 5 or 7 year contracts, and you guys need 20. I mean, there's a big discrepancy sometimes with that. To that point, what are your plans to export gas to Europe from your properties in the Eastern Mediterranean?
Well, we're working on a number of different options right now. We'll probably take an investment decision on an expansion of one of the fields in the Mediterranean early next year. That may supply regional markets more than European markets, but we're advancing a couple of different ideas for LNG exports that could help meet European demand. One would be floating LNG. The second would be to work with facilities in a neighboring country and try to move gas through those existing liquefaction facilities. These things all take some time in terms of commercial negotiations, engineering, and construction, but we're actively looking to expand our position in the Eastern Mediterranean and hopefully bring supplies to Europe in the next few years.
Mike, before we let you go, because I know you got to go jump on your call, I just want to end with the shortages that we're seeing here in the U.S., on the East Coast in particular, when it comes to diesel and distillates. There's been conversations about export bans. How do you wind up getting more product to the Northeast, et cetera? What do you think the best solution of that could be? And what do you think of an export ban situation?
Yeah, we believe an export ban actually carries the risk of unintended consequences. With a market that's tight on supply, you want to encourage supply. And an export ban, actually most of the exports go to Latin America, and then supply to the Northeast comes in part from Europe. An export ban could increase global prices. It could constrain refining capacity because there could be products that can't be sold in the U.S. because of specification differences that therefore would be stored, and then refineries would have to curtail production. The best solution is to take actions that allow markets to work more efficiently, and so that can be things like specification waivers that allow product that's produced that currently can't be sold in the U.S. to be moved to U.S. markets, and to consider waivers of things like something called the Jones Act, which constrains access to shipping to only a very few types of ships to move from one U.S. port to another. A waiver there would bring more shipping capacity into play and enable movements to happen more economically. And so there's some things to allow markets to function quickly and efficiently that I think would be helpful. Constraints on markets, we think, could have some unintended consequences.